Hello, everybody. This is Dave Gilreath from Sheaff Investment Advisors. Remember, we are the firm that uses innovative portfolios for intelligent investors like you. So we have a very grumpy stock market today. It's been a tough year, and a lot of people are getting a little bit edgy. I get it. Your portfolios are black and blue, and that's why I wore this today. It's been a tough time. So we're going to talk about the market, what's happened, what's going to happen, what might happen down the road, we hope anyway. I'm going to share a few slides here, and we'll see if we can unpack some of this. So we have a very grumpy market, as I had said. The stock market, no matter what the index is, whether it's large caps, small cap, value, growth, world, global, doesn't make any difference what the index is. The market has just been pounded, and they're all down double digits, some 25, 30%. I mean, a big top. And even if you go down below there, the bond index performance, every bond market has been decimated this year. And actually, the higher quality bonds have been hurt even more than the lower quality bonds. So investors are also in a foul mood. Consumer sentiment is terrible. Earnings estimates probably going down. We've got inflation. We've got geopolitical problems, but there's always geopolitical problems. Election is coming, there might be a recession, and so what could be down around the corner? So individual investors are a great contrarian indicator, generally speaking. And this is a chart. The top chart here is of the S&P 500, goes back to 1998, right here. And then down below is the chart of the American Association of Individual Investors, the bearish number subtracting the bullish number. So what happens is the net ratio of bulls and bears. And you can see when it's in the red here, that tells you there's a lot more bears than there are bulls in this indicator. And every week they ask these members a question, are you bullish, bearish, or neutral? And this is the answer. And it goes back decades. So it's it's usually a very good contrarian indicator. And what I've done is highlight the times with little red sad faces when that gets to a very extreme level. And as you can see, normally it's a good place to buy. When investors here are very bearish, that tells you it was a good time to buy. Here, very bearish, pretty good time to buy. Here, very bearish, good time to buy. So, and the most bearish one was here in 2009, when it was a great time to buy. Now, there was one time right here in 08 where they were very bearish, and it was a dip, but it dipped a whole lot farther than that. So it wasn't a particularly good time, but generally speaking, it's been a very good time to buy. Right now, we have a negative 43.2% ratio on this bull-bear ratio, which is the lowest it's been since 2009, right here in March 2009. So that tells me that investors are very bearish, which could be a good sign. Now, the other thing is bear markets do end. They always end. And the average bear market, this is according to Ned Davis research, going all the way back to 1929, the average has been 289 days. Well, this one started, our downdraft started January 3rd of this year. 289 days is about mid to late October. So maybe we're getting close, we're certainly getting close to the average end. And there could be a couple catalysts, which I'll talk about in a second, that could change that. Sometimes a lot of our clients and people say, oh my gosh, this is crazy because good news is bad for the market and bad news is good for the market. It doesn't make any sense. And the economy and the stock market are connected, but they're kind of like cousins that only talk at Thanksgiving every other year, and they don't really get along too well, but every now and then they have to talk to each other. The economic data is all backward looking, and but the stock market is a forward looking animal. And so all the reports on the economy are from weeks ago, usually. And the stock market is a discounting mechanism looking forward. So that's why they tend to look at things differently, and they don't always talk to each other. Now, one thing about you're going to hear a lot in the next 4, 5, 6 weeks about earnings estimates coming down and rolling over, and that could be the case. This black line on this chart is forward earnings per share according to FactSet and what's happened, and then you can see where they are now, $240 a share. The blue line is the S&P 500, and the earnings and the S&P kind of track each other pretty well. So right now, the earnings estimates probably are going to be coming down, but even if they come down to this green line, which is sort of the average going forward, which would be like $200, $210, we'd still be in an upward sloping earnings trend. The pandemic screwed everything all up right here, where you can see the earnings just really dropped off the face of the earth and then really caught up and have gone too far, too fast, probably. So now we'll probably see earnings come back again, but it's not going to be the end of the world because PEs will still be okay. I had listened to a chief economist at Fidelity, and he had mentioned the fact that the University of Michigan poll of 5-year inflation expectations has historically been the best predictor of inflation anywhere and over any period of time. And he had all these charts to prove that. But you can see here that this is starting to roll. The inflation expectations are rolling over and going south and heading down into this 2% range, which tells me that sometime, going forward, the Fed might actually accomplish their goal of 2% inflation. So one other thing is the election's coming up 5-6 weeks from now, something like that. It's historically been the case that the incumbent president's party loses seats in the House, and it's happened. You can see this every year. The lines that go backwards with the negative numbers, those are the number of seats that have been lost, and it's happened almost every time. There have been 3 times where they gained, but generally speaking, they lose, and that's kind of falling in line with this year as far as the Congress changing control. And the market likes a divided Congress and a divided presidency and all that. So one party that doesn't have too much power, because the one party in power always spends too much money. That's just the way it is. Midterm year. So this year is a different year because it is a midterm year. Generally speaking, as you can see in the black line, there's all other years besides midterm years. And this goes back, back to 1931, where generally speaking, the stock market, the black line here, on most years goes up through about halfway through the year and then flat lines, and then has a couple months at the end that are strong, what's called the Santa Claus rally. Well, a midterm year has an okay first quarter and then just languishes and falls through about September, October. And then normally October, November, December are very, very good for midterm years. And that easily could be the case this year. There's 2 catalysts. One is the election, which most investors like that when that happens, when the presidential party in power loses seats. And number 2, this year, I think we could get maybe November-ish, some clarity on what the Fed is going to do. And that could be another catalyst for a good closing quarter, last quarter of the year. The last thing that I'd like to leave you with is that after the midterm election, historically, since World War II, has been an up stock market for the next 12 months, always. And you can see in the green highlight there that typically the market goes up double what it does in a normal year. So it goes up 15% on average in the 12 months following a midterm election year. And some of them have been very high, from the 20s, 30%. So we can hold out hope that that'll be the case this year. And, if it is the case, then we're going to have a good 12 months after the election. If it's not the case, well, we'll have to take that when it comes. Thank you for joining us. Hope you have a good afternoon or evening. Bye-bye.